Hello, everybody. Welcome to Wealth Window. Today, we are going to continue a new series called Investing 101. This video will specifically focus on asset allocation. By the end of this video, you should be able to understand the principle of asset allocation and be ready to apply it towards your investing strategy. Now let's get into the video. Asset allocation is a fundamental concept in investing that refers to the process of distributing your investment portfolio across various asset classes, such as stocks, bonds, and cash. The goal of asset allocation is to balance risk and reward according to your individual investment goals, risk tolerance, and time horizon. By strategically allocating your assets, you can potentially enhance returns while minimizing the impact of market volatility. One of the key reasons asset allocation is so important is the principle of diversification. By spreading your investments across different asset classes, you reduce the risk of a significant loss. For instance, if one sector of the market underperforms, other sectors may perform well, helping to cushion your overall portfolio. This approach not only helps in managing risk, but also positions you for more stable long-term growth. In this video, we will delve deeper into effective asset allocation strategies and provide real-world examples to illustrate how you can implement these concepts in your own investment journey. Whether you're a seasoned investor or just starting out, understanding asset allocation can empower you to make informed decisions and build a resilient portfolio. Stay tuned to learn how to optimize your investments for success. Asset allocation is the strategic process of distributing your investments across different asset classes to achieve your financial goals while managing risk. The core idea is to create a balanced portfolio that can withstand market fluctuations and provide a steady return over time. By diversifying your investments, you can reduce the impact of any single asset's poor performance on your overall portfolio. The role of asset allocation in your investment strategy is crucial, as it helps you balance risk and return. Different asset classes respond differently to market conditions. For example, stocks may offer higher potential returns but come with increased volatility, while bonds typically provide more stability and lower returns. Cash, on the other hand, serves as a safe haven during turbulent times but often yields minimal returns. By understanding how to allocate your assets among these main classes, stocks, bonds, and cash, you can tailor your investment strategy to align with your risk tolerance and financial objectives. This thoughtful distribution not only helps in mitigating risks, but also positions you for long-term growth. Over the next few minutes, we will explore how to effectively implement asset allocation in your investment journey. When it comes to asset allocation, investors have several strategies to choose from, each tailored to different investment goals and market conditions. One of the most common approaches is strategic asset allocation. This long-term strategy involves setting a fixed percentage for each asset class in your portfolio based on your risk tolerance and investment objectives. The idea is to maintain this allocation over time, allowing for gradual growth while minimizing the impact of short-term market fluctuations. In contrast, short-term asset allocation offers more flexibility. This strategy allows investors to adjust their asset mix in response to current market trends or economic conditions. By actively shifting investments among asset classes, short-term investors aim to capitalize on market opportunities and enhance returns. However, this approach requires a keen understanding of market dynamics and can involve higher risks. Another strategy is dynamic asset allocation, which involves making ongoing adjustments to your portfolio based on changing market conditions. Unlike short-term allocation, which is more static, dynamic allocation is responsive and can involve frequent rebalancing. This strategy allows investors to take advantage of market volatility while managing risk effectively. By understanding these different asset allocation strategies, you can choose the one that best aligns with your investment philosophy and goals. Understanding risk tolerance and time horizon is essential for effective asset allocation. Risk tolerance refers to an investor's ability and willingness to endure fluctuations in the value of their investments. It varies significantly among individuals, influenced by factors such as age, financial situation, and personal comfort with uncertainty. For instance, a younger investor may have a higher risk tolerance, allowing them to invest more heavily in volatile assets like stocks, while someone planning to retire in the next 5 years might prefer a conservative approach with a focus on bonds and cash to preserve capital. Time horizon plays a crucial role in shaping asset allocation as well. It refers to the length of time an investor expects to hold an investment before needing to access the funds. A longer time horizon typically allows for a more aggressive asset allocation, as there is ample time to recover from market downturns. Conversely, a shorter time horizon necessitates a more conservative approach to protect against potential losses. For example, a 30-year-old saving for retirement in 30 years might allocate a significant portion of their portfolio to stocks, while a 60-year-old planning to retire in 5 years may prioritize bonds and cash equivalents. By aligning asset allocation with both risk tolerance and time horizon, investors can create a strategy that suits their unique financial goals. To better understand asset allocation, let's explore some real-world examples of different strategies tailored to various risk profiles. First, consider a conservative portfolio designed for risk-averse investors, such as retirees or those nearing retirement. This portfolio might allocate around 70% to bonds and 30% to stocks. The higher bond allocation provides stability and income, while the smaller stock portion allows for some growth potential without exposing the investor to significant market volatility. Next, we have a balanced portfolio that aims for a middle ground between risk and return. This strategy typically involves an equal distribution of 50% in stocks and 50% in bonds. This balanced approach allows investors to benefit from the growth potential of stocks while still enjoying the stability and income provided by bonds. It's suitable for individuals with a moderate risk tolerance and a longer time horizon. Lastly, an aggressive portfolio is ideal for investors seeking high growth and willing to accept higher risk. This portfolio might allocate 80% to stocks, focusing primarily on high-growth sectors like technology and emerging markets, with only 20% in bonds. This strategy aims for maximum capital appreciation, making it suitable for younger investors or those with a strong appetite for risk. By examining these examples, you can see how different asset allocation strategies align with various investment goals and risk tolerances. Rebalancing your investment portfolio is a crucial practice that helps maintain your desired asset allocation over time. As market fluctuations occur, the value of different asset classes can change significantly, leading to an unintended shift in your portfolio's allocation. For example, if stocks perform exceptionally well, they may comprise a larger portion of your portfolio than originally intended, increasing your overall risk exposure. The rebalancing process involves adjusting your portfolio back to its target allocation. This typically means selling some of the assets that have grown disproportionately and buying more of those that have lagged behind. By doing so, you can maintain your desired risk levels and ensure that your investment strategy aligns with your financial goals. As for when and how often to rebalance, there are a few strategies to consider. Some investors choose to rebalance on a set schedule, such as quarterly or annually, while others may opt to rebalance when their asset allocation deviates by a certain percentage, like 10% or 15%. Additionally, it's essential to consider transaction costs and tax implications when rebalancing. By regularly reviewing and adjusting your portfolio, you can stay on track toward achieving your investment objectives while managing risk effectively. In this video, we've explored the vital role of asset allocation in achieving your investment goals. By strategically distributing your investments across various asset classes, you can balance risk and return, ultimately positioning yourself for long-term success. We discussed different asset allocation strategies, including conservative, balanced, and aggressive portfolios, each tailored to different risk profiles and financial objectives. That will wrap up this video. Subscribe and turn on notifications so you don't miss more videos related to business, personal finance, and much more. Be sure to check out this video about investing for beginners, and I'll see you in the next one. Take care.